part, we will be having a refresher on important provisions of GST with reference to Bank Audit. I'm quite sure that the session today will be very useful to all of you, since all of you are gearing up for the Bank Audit also. We have a very important faculty. The details will be given by Secretary Joe. I have few points for you. One is that you are eligible for CP unstructured credits for 2 hours after attending this seminar, this online meeting. You will have to log into ICAI website and claim your CP unstructured credits by clicking on CP link and submitting an self-declaration that you have attended this online meeting. That is one thing. The second thing, kindly see that you keep your audio muted throughout the session. If audio is on, I think it will create unnecessary howling problems, and also please see that your audio is muted till the end of the session. If you have any queries, you can put in the chat, or you can even send SMS to the secretary is there, Josie is there, myself is there. You can send there your queries if there is any. And if you want to talk, you can put the same request in the chat itself, so that when you are allotted the time, you can talk then. So please see that your audio is muted till the end of, please. Somebody's audio is now making unnecessary noise. Please see that your audio is muted. And another thing is that you know it very well that ICAI has came out with an ICAI COVID relief fund, and head office is they're gearing up to give around 21 crores as a ICAI COVID relief fund to the government. First installment has already been given. A lot of sufficiencies have been given to each one of us to support it generously. It's my request to all of you to support ICAI initiative. You can directly log into ICAI website and support, or else you can even send funds to branch. We will be submitting that directly forwarding to ICAI head office. So this is all I want to tell you, and please see that you have a wonderful session here today. We hope that you will have a wonderful session. I'm passing on to Secretary Joss.
Thank you, Roisa Chairman. So today we have a speaker, CA Shankara Narayanan. I think we do not require any introduction as such, because he is a very close friend of our branch. He is a frequent speaker here in our branch. He is the partner in GPVS and Associates, Chennai and Bangalore, and very expert in goods and services tax. With this word, Shankara sir, over to you. You can commence the webinar, sir. Shankara sir. Yeah, there was some technical issues. I think it's getting solved.
Hello, sir. You are able to hear me, sir?
Yes.
Yeah. Okay.
Over to you, sir.
Yeah, maybe you didn't hear the first part. I have to repeat. Yeah. I thank the ICAI Ernakulam for organizing this event, as well as the
some problem, no? I think.
Hello, sir. You are able to hear me?
Yes. Now, yes.
Yeah.
Yes.
On March 14th, we were supposed to have a session, and that got postponed because of COVID. And now we have the session with COVID-related notification. which have come. So what has happened in the intermittent period, which has resulted in certain notifications coming into picture, which is critical for us to understand, because there is a general thinking that the notification has come up with a lot of benefits. Yes, there are some benefits, but there are equally things that we need to note as people who are practicing taxation. The first notification which I want to bring up, all these notifications have come in Marseille on 3rd April 2020. That is when these notifications were issued. And Rule 36 sub Rule 4 is the first part which I wanted to elaborate. In notification 30/2020, CGST rate notification. In that only we had this provision coming into picture. That on the Rule 36 sub Rule 4, the restriction which had come from October 2019, wherein the credit can be availed only when the matching has happened. So GSTR 2A matching was made mandatory. So that provision has been put on hold for the months February till August 2020. So it is not said that it is done away with. It has only been put on hold. That means my suppliers may or may not report. Still, I can take input tax credit for these months from February 2020 to August 2020. The ITC can be availed, but cumulatively by September 2020, I must do the reconciliation. So the leniency is given only in terms of postponement, not in terms of removal of this provision. So this is the first provision that has come. So 36 sub Rule 4, we need not worry. So all the larger corporates are already aware of it. A circular number 136 has been issued, wherein also they have clarified that the larger corporates can take input tax credit irrespective of whether their supplier has reported it or not in 2A, but ultimately by September 2020 they have to ensure that it is getting reported. So this is the first notification 30/2020. The next aspect is on GSTR 3B. So has the due date been extended? The answer is a resounding no. For people whose turnover is more than 5 crores, aggregate turnover is more than 5 crores, for their returns of February, March and April. So we are talking only 3 months, February, March and April. The due dates have not been extended. The due dates remain the same. But what has come through the notification is, if we file the returns of these 3 months before 24th of June 2020. So typically for February it is March due date, for March it is April due date, and for April it is May due date. So all these due dates have been not extended, but a provision has been inserted wherein it is told we are not liable to pay late fees if the 3 months returns are filed before 24th June 2020. So what lies ahead is, if we do not file any one of these months returns, let's say February and March is filed, April is not filed by 24th of June 2020, then the late fees will be applicable right from the first day of delay. Because the due date for the month of April is still 20th of March, 20th of May 2020. So that is the issue that we have to be aware of. One. And second thing, have they done away with interest? No. Interest is still applicable, but the provision that has come in place is the interest meter will start only after 15 days from the due date. That means for the month of March, the due date was April 20th. But I did not pay by 20th. I filed my return and paid the tax only by May, which is well within the 15 days time limit from the due date. I don't have to pay any interest. And already, as we discussed, there is no late fees also. There is no late fees, there is no interest. Suppose I am not able to file it by May 5th, I am filing it only by 15th of May. Then what would happen? If I am doing it by 15th of May, the late fees provision will still be applicable. That means I don't have to pay late fees because I am filing it well before 24th of June 2020. But interest provision will kick in because 15 days from the due date is already over. The 15 days from the due date of 20th of April has already got expired, which is 5th of May. So from 6th May till 15th May, I am liable to pay interest. Now this is the first understanding that we must have. So the first step in interest is for the first 15 days of delay, there is no interest, and any delay beyond that 15 days, there will be an interest, but that interest will be 9%, which is half of the normal interest which we pay under section 50 subsection 1. File the returns before 24th of June 2020. Now, when it comes to more than 5 crore assessee, this date of 24th June 2020 is remembered. The 3 months return, February, March, April, must be filed before this date, on or before this date. If it is not done, then none of the benefits that we have seen so far is applicable, which means late fees will be applicable right from the next day from the original due date. Interest will be applicable at the rate of 18% right from the day next to the due date. So after this, thinking that the working capital flow can be pushed, they cannot push it beyond 24th June, especially after this having more than 5 crores aggregate turnover, and the 3 months is only February, March and April. With the lockdown getting extended to May 3rd, we have not received any further notifications for the month of May, and we may have to wait and see if it gets further extended. From May 3rd, any such notifications comes into picture. But as of today, this is the position. So the first part, what I have tried conveying by way of notification 31 and 32 is for assessee whose turnover is more than 5 crores, the large assessee. No late fees, reduce the interest, but only if you are going to file before 24th of June 2020. Now we move on to the next tier of taxpayers who are having turnover more than 1.5 crores, but not more than 5 crores. So the turnover is more than 1.5, but not more than 5 crores. In these cases, what will happen? These 3 months return, their due date is extended as I have shown in the screen there. For the month of February and March, their date is 29th of June 2020. So if they manage to file the return, pay the tax by 29th of June 2020 for the first 2 months, that is February and March, if they are able to do that, then there is no late fees, there is no interest. And for the month of April, their due date shall stand as 30th of June 2020. So this is the tier 2 assessee whose aggregate turnover is more than 1.5 crores, but not exceeding 5 crores. For them, it is 29th June and 30th June. And now the last year, which is aggregate turnover is not more than 1.5 crores. People who have the turnover up to 1.5 crores. In those cases, also there is an extension. There, the extension is as I have put it on the slide. For February, the due date shall stand as 30th of June 2020. And for the month of March 2020, it shall stand as 3rd July 2020. Tier of assessee. So more than 5 crores, 1.5 to 5 crores, less than 1.5 crores. 3 different assessees, 3 different types of due dates and waiver of late fees and interest in certain select cases subject to conditions. The sum of it is available in notification 31 and 32. The clarifications are also provided in circular number 136. So moving further, notification number 33/2020. So what we have seen so far is only for filing of GSTR 3B. So the 3 tiers is only for GSTR 3B. We have not seen anything with respect to GSTR 1. So for GSTR 1, this notification number 33/2020 says that across the board, for everybody, it says the late fee is waived for the month of March, April and May 2020. Please note, it is the return for the month of March, April and May. it is not the returns filed during March, April and May. Because for 3B, what we saw was for the returns filed during March, April and May, which meant that February was included and May was not included while we were discussing 3B. But when it comes to GSTR 1, February is not included. So GSTR 1 of February, we should have filed and there is no delay or postponement by the government. Only for the month of March, April and May 2020, GSTR 1, there is an extension. And that extension shall stand as 30th of June 2020 for all this 3 months. So for 3B, it is February, March and April. For GSTR 1, it is March, April and May. This final point is brought out by notification 33/2020. So February is GSTR 1. If any assessee is still not filed, tell them that the late fees is still applicable in those cases. Moving on to the next part, which is again critical for the movement of goods. Notification number 35/2020, dealing with e-wables. E-wables which have been raised and expiring between 20th March to 15th of April 2020. So any e-wable which is expiring, which is not raised, which has been raised prior to this date, that is 20th March to 15th April, but expiring during this period of 20th March to 15th of April. What has been told is it is deemed that all these periods are automatically extended till 30th of April 2020. That is their date of expiry. It stands extended till 30th of April 2020. And with the lockdown extending to 3rd of May, I feel a further extension is on the cards. Because originally it was up to April 30th. So what they had told us, we will keep it up to 30th of April 2020 because the lockdown was only from 24th of March till mid of April, 14th of April. That time they had given this notification stating that the extension is up to 30th of April. Now that the lockdown itself is extended up to 3rd of May, this may further get extended by any notifications which we can expect in a week or so. So this is with respect to e-wables. And I don't think anybody other than essential commodity movers would have raised e-wables in this intermittent period because none of them have been allowed to raise e-wables during this period. Moving to the very important part, especially for people who have received any notice, who have applied for refund, who refund application has been put on hold due to deficiencies. For all of us, this new section 168A has been inserted by the tax ordinance, and that 168A has been given light by the notification, and that notification covers and it says that any time limit for the purpose of, and it is not only this, what I have listed there, the time limit for these, that is completion of any proceeding or passing of any order or issuance of any notice or intimation or notification or sanction which is precisely for refund or any approval or any other action by whatever name called by any authority, commission or tribunal. As of now, tribunal or getting to a commission has not happened, or any authority orders by whatever name called under this act, or filing of any appeal, reply or application. There might be a pending reply from our side which we are not able to give. Furnishing of any report, document, written or such as a record or statement falling within 20th of March till 29th of June shall be extended till 30th of June. So wherever it has been told that this is the timeline, there it will expire. For example, a refund application, a deficiency notice has been issued, saying that the deficiency has to be fixed, and the deficiency notice is valid for say 15 days. The deficiency notice has been issued on 10th March. It expires on 25th March. Now, it shall not expire on 25th March. It shall expire on 30th of June 2020. We have time up to that to submit our reply or close the deficiency. Same way, any notice issued by them, any intimation of giving the replies to them. Like for example, this is mismatch. You have to give further information. In all those cases, it stands extended up to 30th of June 2020. So between these extended up to 30th June. The only issue that I have seen so far is the system is not accepting it. So what is happening is the system is still not tuned or changed to 30th June. So the system doesn't allow the officers to do their extension. But eventually, I think that it will be resolved. From a legal perspective, we can rest assured that any replies or any kind of orders or notices that we should have replied within 20th March to 29th of June shall all stand extended to 30th of June. Now moving away from the COVID notifications, let's get into the bank statutory audit perspective. Any GST related provisions which would have a larger impact on it. Now I have put up this content taking two things into consideration. One is the branch statutory audit as well as the overall audit of the bank, where it could happen at a region level or it could happen at a zonal level. So those places also certain complaints needs to be looked in. So some of it may not be relevant for a bank branch. Some of it may be relevant only for zonals or regions. Some of it may be relevant even for the central statutory audit. So keeping all that into consideration, I have prepared this content. Let's get into the bank audit perspective of this GST for the bank audit for the financial year 2019-20. Now the first part is on the place of supply. It is a cursory check that we may have to do. There has not been any amendment from it from in these provisions from the last year. So 2018-19, whatever it was, should continue in 2019-20. The test that we may have to do the place of supply is to identify whether the CGST and SGST or ICST has been charged appropriately. Because certain cases there is a slippage, which we have come across and notified by few other fellow chartered accountants. So the provision that we need to remember when it comes to a transaction of a bank rendering a service to another person who is within India. That means the bank is also within India, the recipient of service is also within India. Then section 12, subsection 12 of the IGST Act talks about place of supply. It says the location of the recipient as per the records of the bank shall be the place of supply. So it doesn't matter whether that person is a registered person or an unregistered person. Wherever he is located, the address of the person as per the KYC documentation, wherever it is located, that shall be the place of supply. The place where we saw the slippage or a lacuna is one of the companies is having a bank account with a bank which is in Mumbai, but the company is located in Chennai. So all the transactions that the bank does with this company cannot have CGST and SGST. It must only be IGST, because they know very well that the company that they are serving is situated in Chennai. Generally, we may not see this scenario because people would want to have a bank account very near to their office. This company, being a multinational company, they have opened an account with a bank which has branch only in Mumbai. So in that case, we saw this problem where the initial one or two invoices they were issuing were all containing the provisions of CGST and SGST of Maharashtra. So we had to tell them, and they corrected their system and reissued the documents for us that it is IGST. So it is the location of the recipient as per the records of the bank that needs to be taken into consideration. And moving further, if it is not available, in all those cases, it is straightforward. We can go for CGST and SGST. If it is going to be a transaction between the bank that is located in India with a person who is not even in India, it could be an entity, it could be an individual who is outside India. In all those cases, the place where the banking company is located, that is the service provider is located, shall be the place of supply. So this needs to be taken care in all those forex or foreign transactions, letter of credit, or those transactions where the bank might have done with people who are not in India. IGST should have only been applied. And The zero-rated supplies where we need to be careful, as I said, export of services. That is where the recipient happens to be outside. One and second common place where we have seen some slippages is services to an SEZ, Special Economic Zone. And when we do the audit, we may go across and check whether any new SEZ accounts have been opened during this year. Because if the system is not updated as to whether that person is a normal person or an SEZ, the system wouldn't charge, whether it is IGST or CGST and SGST. It will still take up CGST and SGST because it will think the person is still residing within the same state. But the person being an SEZ, though it is within the same state, we are supposed to charge only IGST. So this place of supply related intricacy may have to be checked at least for the new accounts that have been opened during the year. Moving to the next part, the very important as well as unique provision, which is applicable only for banks, financial institutions, cooperative banks, and NBFC. Section 17, subsection 4 offers them a provision or an option. Instead of reversing the input tax credit in proportion to their exempted turnover, which being the interest. Section 17, subsection 4 has given them the freeway to avail a standard benefit. That is, avail only 50% of the eligible input tax credit. This option has been given for banks and financial institutions. There were certain degree of questions and confusion in terms of whether cooperative banks will come under the definition of banks and financial institutions. The answer is a resounding yes. The Banking Regulation Act, Section 56, says that the cooperative banks, though they are not coming under the category of banking company, the word banking company is what is told in Section 5 of the Banking Regulation Act. So, though they do not come under the definition of a company, still, all the provisions of the Banking Regulation Act shall apply to a cooperative society also, as if they are equal to a banking company. Hence, we don't have to differentiate cooperative banks in this case. They are equal, they are same in terms of banks or financial institutions. And it is applicable for non-banking financial companies also. The provision that is applicable is 50%. So the 50% rule will have to be carefully looked at because it is 50% of the eligible input tax credit. It is not 50% of the all the IT. If it is not eligible, 100% is ineligible. We cannot even touch that invoice. So a bank branch takes an ITC or at a regional level or zonal level when they are doing consolidation, if they are reversing 50%, what we need to check is have they availed only those credits that they should have availed, which means eligibility. Out of that eligible credit, they can go ahead and remove 50%, that is reverse 50%, which they are not entitled to. So they are asking for Section 17, Section 4. So this is the care that we need to take on first part. So this 50%. Yeah. Hey,
Hello, there are some disturbance. Kindly mute, please. Yes, sir.
Yeah. The 50% rule, this first part applies for the eligible. Branch, the forex branch is raising an invoice on the Kochi branch. Now, in those cases, those invoices, the 50% rule does not apply. They are eligible to take 100% input tax credit. That means the full ITC can be availed. This has to be checked because the first 50% people are aware, and what they have to do as a filter is out of the ITC that I am getting, evaluate whether it is eligible ITC, and on that eligible ITC avail 50%. Second part is out of the ITC that I am getting, is it from my own entity distinct person? So the answer is yes. In that case, no need to cut off 50. You are eligible to take 100. This provision is elaborated in the section as well as in the rule. So we need to be aware of this when we are availing the ITC. So the first critical provision in ITC for doing bank audit is this. So taking it further, Rule 36 sub Rule 4 again comes into picture because this is the first financial year, 1920, where during the financial year, that is from 9th October 2019, by way of a notification, the matching of GST R2A has been made mandatory. And for the month of October, November, and December, it was 20%. And then from the month of 1st of January 2020, they have reduced it to 10%. What is this 20% and 10%? Credit, which are not there in my 2A, can I avail? The answer is yes, but that availing credit of not appearing in 2A cannot exceed 20% of the credit that is appearing and eligible. Mechanism has happened within the banks. If the matching mechanism has not happened, that is, reconciliation has to be checked. If the reconciliation has not happened, we may have to look at qualification. Because reconciliation has not happened as per the legal provisions, they are supposed to repay the credits. It may be 50%. In this cases, we have to be given back to the department. Hence, we have to be careful in evaluating this. And the other point that I need to stress on here is the notification came on 9th October and it said any return filed from 9th October. Interestingly, September 2019 return would have been filed, that is 3B, would have been filed only after 9th October because the due date itself was 28th October. So this provision technically becomes applicable right from September's return. Because returns filed from 9th of October, if they had belatedly filed for the month of August after 9th October, then for August also this will become applicable. So this care has to be taken while referring to Rule 36 sub Rule 4, where this is the first year of introduction. If this is not establishable as to whether the reconciliation has happened or not, please consider, check with the Central Statutory Auditor or the region coordinators in terms of what kind of qualification needs to be placed, because this can result in a contingent liability. Moving further, the Rule 37 related provisions, especially whether irrespective of whether the branch is settling the payment or the payment for the creditor invoices are settled at a region or a zonal level. Why this needs to be taken into consideration? The restriction put on by section 16, wherein the creditor has to be paid within 180 days and especially 180 days from the date of his invoice. It is not 180 days from the date the bank has booked the invoice, because most of the cases, including the audit fees in case of concurrent audit or some audit or stock audits, the invoice is booked only when it is being followed up. So there is a possibility that even those invoices which are more than 6 months old are being booked. So what is the problem? The problem is from the minute of booking, the system will automatically take the input tax credit. But actually speaking, they don't become eligible to take the ITC while booking itself, because 6 months from the date of invoice, they have not made the payment. So what they are ideally supposed to do is take the credit and reverse it immediately in the same month and take the credit again only when the actual payment is made. So this provision has to be kept in mind for the first part, that is general regular bill processing. We may do a aging analysis where we have to check whether any invoices are pending beyond 180 days without being paid. If it is pending beyond 180 days without being paid, this provision of reversal of ITC needs to be invoked. One part. The second part, which is even more critical, where again at a consolidation level we have to look at it, is those invoices which have been raised on the bank, but the bank has disputed those invoices. What happens in those cases? There might be a dispute, they will still be disputing, they may not be coming to a conclusion. In all those cases, is the bank going to take a stand to avail the ITC or not? Because let us say a law firm has raised an invoice on the bank. Let's say they have said that we are going to charge you 2 lakhs. But the bank is saying, no, we expected only an invoice for 50,000 rupees. What is our role in this? Very simple. Our role in this is we have to quantify reverse charge liability. If the bank is going to say my liability is 50,000, they must have paid reverse charge liability on 50,000. But we do not know how much the bank will end up paying. But tomorrow there might be a possibility that the bank will pay 2 lakhs. Then they may have to pay RTM on 2 lakhs, not on 50,000. This has to be quantified by us, which will have a role to play in the contingent liability, one part. Second, where there is an invoice, let's say an interior decorator for furnishing the branch or the regional office has raised an invoice on them where they are disputing. Now, on this furniture and fixtures, are they going to avail ITC? Yes, they will go by the 50% rule. But are they going to avail all the ITC that is mentioned in the invoice, or are they going to avail only that ITC which they are going to pay? And there also, how much they have paid will play a critical role. So we have to test or at least ask the bank or the region in terms of how much of those invoices are under dispute and what is the GST treatment that they are going to give on those invoices. Because if they intend to avail full ITC, then they must pay the full amount. The 180 days rule will come into picture. If they intend not to avail a single rupee of ITC, we don't have a problem because the whole invoice will go away from GST perspective. But the intention to avail ITC is there. This has to be checked and qualified or checked and verified in terms of the correctness. The next part is on the input service distributor. Out of the 8,000 and odd ISD registrations across India, the majority of people who are registered are the input service distribution registration is for banking operation. So the common input tax credit at every level could be at a corporate office level or at a region or a zonal level, everywhere. The common ITC for services should be distributed. So we need to check whether the bank has adopted that. If they have done, what is the basis of distribution? Is it in line with expectation of Rule 39, read with Section 20 and 21? That is in terms of the turnover of the people to whom it is being distributed and their turnover in the previous financial year, whether that has been taken. And what is the methodology? Is the distribution happening on a monthly basis or is it happening on a quarterly basis or at will? This needs to be checked. And then the ISD, Input Service Distributor, credit notes. I have distributed a credit, but subsequently my supplier says I don't have to pay so much, so I reduce the payment to him, which consequently reduces my ITC also. So head office is received an invoice. That invoice, they have distributed the credit. Subsequently, the payable on the invoice comes down, so the ITC will also come down. In those cases, what are they supposed to do? They should have issued an ISD invoice to reduce the input tax credit availed by the branches. Have they done it? Needs to be checked. And reverse charge mechanism, if it becomes applicable for the HO or the region officers, which are not registered separately, which are having only the ISD registration, how they are handling reverse charge transactions. Is it being paid by the branches? Because reverse charge transaction, the payment of tax has to be done, which cannot be done by an ISD registration. The payment of tax and the reverse charge can be done only by a normally registered person. So this needs to be taken care. So Rule 39, ISD related provisions, if it is applicable for the bank, check whether those credits have been taken. If it is there, check whether the distribution mechanism has happened properly. At a branch level, distribution mechanism we cannot question. We may have to question it at the level where they are distributing it from, the zone, region, or the head office level. Now moving further, last year 1920 saw the mergers. Lot of mergers happened, especially in banks, and from 1st of April 2020 also we have seen some mergers happening across banks. What is the impact of it? So this may not be at the branch level, maybe at a higher level. What we need to check is every state where there is a merger. That means takeover of business and not just takeover of assets. Because if it is a takeover of assets, it is taxable as supply. If it is a takeover of business where the assets and the liabilities are taken over as a going concern, then it is not treated as a supply. There is no need to pay GST. But there is a catch. The catch is that the takeover must be certified as it is a takeover of business and it is not a takeover of assets by a practicing chartered accountant or a cost accountant. And that declaration or certification by the auditor must be uploaded in the return called ITC 02. So what we need to check is whether this ITC 02 has been filed. It will happen at a state level because ITC 02 is GST wise. So it need not be filed by every branch. Every state, one ITC 02 should have been filed, especially when there is a happening of merger. So those branches which you are looking at, so we need to check whether this ITC 02 has been filed along with the certification for the takeover as to whether it is only a takeover of business and not a takeover of assets. And the carry forward input tax credit from the old registration to the new registration should have happened. The purpose of filing ITC 02 is only to carry forward that input tax credit which is lying. So this should also form part of our verification of input tax credit when we are doing this bank audits. Taking it further, the other very important scenario which can happen at a branch level is disposal of any capital goods or plant and machinery. In case of a bank, the plant and machinery or the capital goods predominantly that they will be using will all be electronic, the information technology related assets. Had they availed input tax credit on those, it is not applicable for those capital goods on which input tax credit has not been availed. The provision that we are discussing, 18 subsection 6, is applicable only when the capital goods on which ITC has been availed in the past. Those capital goods are getting disposed now. What can happen? What should have happened? That 5 percentage points for every quarter of putting the asset to use shall only be eligible for them. The remaining amount of ITC that they had availed should be reversed at the time of disposal of capital goods, or the GST on the transaction value of the goods, whichever is higher, shall have to be reversed. Let us say, for example, in 2017 July, they had purchased a computer which they have scrapped during 2019 December. So it is ideally put to use for 2.5 years. In other words, it is put to use for about, say, 4 plus 4, 8 plus 2, 10 quarters. They are eligible for every quarter only 5% of the ITC that has been availed on the asset. 10 into 5%, they are eligible only for 50%. The remaining 50% value they have to calculate. And what is the disposal value of the computer? On that, the prevailing GST rate, which is 18%, they have to calculate. That amount of 50% of the ITC availed, or the 18% on the disposal value, whichever is higher, should have been paid as GST at the time of disposal of the capital goods. So any disposal, if the branch says it is a scrap that has been sold, is it a capital goods is the question. If it is a capital goods, the next question should be, has ITC been availed? If ITC has been availed, check whether this calculation as per 18 subsection 6 has been done. So this can happen for any revenue which they put as miscellaneous income. We need to check whether the capital asset disposal has resulted in the miscellaneous income, and this provision compliance needs to be verified. Moving further, few aspects of valuation can happen at a branch level, can happen even at a regional or zonal level is the first part, penal interest, where the provision was not very clear, or from a department side we didn't have clarity, which was fluid, has been fixed by this 28th of June 2019 notification. So this clarity came only in this financial year 2019-20 by way of a circular. Earlier there was a doubt, there was ambiguity in terms of whether penal interest will be taxable under GST or not. It has been categorically clarified that penal interest on account of a loan transaction, where it is a money that is lent, on that money there is an interest that is payable, on that interest there is a penal interest that is being levied because there is a breach in terms of timelines. In those cases, it will not be taxable, or rather I would say it will be exempted. Why is it getting exempted? Because it gets added to that interest, and interest being exempted, the penal interest is also exempted. Whereas if I am a trader in goods, I am accepting payment in installments and I am collecting penal interest on it, that becomes taxable. Where I am a funder, I am giving loan, on that there is a penal interest, that becomes exempted, clarified amply in Circular 102 dated 28th June 2019. So we have twofold responsibilities. One, to check whether the bank has complied with this, that is not charging GST on penal interest, because before 28th of June there was ambiguity, hence certain banks operated by charging GST on the penal interest also. One. And the second responsibility that we have is, had a bank done this, that is collected and taken GST on penal interest, we must ensure that they have paid the amount collected as GST to the department, because whatever is the money that is collected in the name of GST must be remitted to the government. Whether it is actually taxable or not, if we are collecting it in the name of GST, Section 76 says that it must be remitted to the department. Then later on we can say we have wrongly remitted, please give me refund. But if you have collected it, it must be remitted to the department. So ensure that the penal interest related logic is applied, and with respect to procedure, whether it has been complied. The second aspect of valuation, special valuation, is applicable for certain transactions. In that, the first transaction that gets attracted for a bank or a financial institution is forex business. The foreign exchange dealing branches which have been made as AD, authorized dealers under FEMA. For them, the GST applicability, what is their transaction value? So Rule 32 gives them a special method of valuation. Two methods are offered. Most of them, 99% of the people have gone only for the tabular method, where if the value exchange is up to rupees 1 lakh, they consider a certain portion, that is a percentage, as only the taxable value, and if it is more than 1 lakh, up to 10 lakhs, a certain percentage, and if it is more than 10 lakhs, a certain percentage is deemed to be the value. What is all this? This is a special method of valuation. On that calculated value only, GST is payable at 18%. So for example, if I am exchanging, say, dollars worth 95,000, then in that 95,000, only 1% will be considered as my taxable value. On the taxable value only, GST will be payable. So this has to be taken in unison and checked separately, because banks, not all the branches, some branches will certainly have this forex related transaction where the applicability of this methodology and reporting the same in the GST returns, because the transaction value might be 95,000, but the taxable value will only be 1% of it, and the GST will be only 18% of that 1%. Have they reported it properly in their GSTR 1? Needs to be verified. Hence, the forex business, wherever it is there, needs to be checked. And the second provision that we need to be aware of is the forex transactions interstate, that is between one bank to another bank, between one authorized dealer to another authorized dealer, bank and authorized dealer. Any such forex transactions are all exempted. There is no need to charge GST. Check whether those exemptions are being properly utilized and put in place. So forex related business, two places we need to be careful. Moving further, very important provision for the banks or the financial institutions which do the hire purchase funding, and especially if they have done any repossession. This provision is unique and applicable for banks and financial institutions, and this provision that we are discussing in Rule 32 Proviso is applicable only if the repossession is happening from an unregistered borrower. It is not applicable if the repossession is happening from a registered borrower. Only from an unregistered borrower, let us say a machinery he has taken or a vehicle he has taken on hire purchase, but he has not turned up in terms of money repayment, then he becomes a defaulting borrower. If he is a defaulting unregistered borrower, then the bank will repossess the asset. But now comes the problem. This repossessed asset or the item will have to be resold by the bank. When they resell, do they have to pay GST again? For this only, the special method of valuation has been put in place, which says that when the item is being repossessed, we will tell you what is the value of the item that is getting repossessed. How to calculate the value? The calculation methodology shall be from the original purchase value, that is the original value at which it was sold to that borrower. Take that value for every quarter or part of a quarter for which it has been used by that person till the date of disposal by the bank. That means it has been repossessed and kept at the bank for 1 quarter. Then that should also be taken into consideration. For every quarter or part of a quarter, 5% shall be the reduction in the value of that item. That needs to be given. Let us say the original value of the item was 10 lakhs and it has been used for 8 quarters, then subsequently repossessed and kept by the bank for 3 more quarters before being disposed. So in total, 11 quarters have expired from the original date of sale till the subsequent sale. For 11 quarters, 5% per quarter would mean 55% of the value will be depleted. So now we are eligible, or we can call only 45% of the original value as the repossessed value. That is the value of the item in your hands. Okay, now what should I do? Now we are going to sell it. The bank is going to dispose it off. When the bank is disposing it off, if it is selling it any amount over and above this 45%, GST needs to be paid only on the differential amount. Let us say the bank is disposing it off at 50% value. Then on the 5% only, that is 50% minus 45%, we need to pay GST only on that 5%. But if they are going to dispose it off at 40% of the value, not a single rupee of GST needs to be paid by the bank, because you are selling it below the price, the repossessed value, as put forward in this proviso to Rule 32. So please make a note of this, especially hire purchase business related banking operations where the default repossession happens when it is a defaulting unregistered borrower. This provision needs to be kept in mind. So moving further, the one area where I have been clarifying to chartered accountants as well, the audit fee, GST on audit fee, there is no doubt on it. Now the doubt or the ambiguity arises only on the GST and reimbursement. The travel, the stay, the food expenses. In all those cases, some banks took an illogical stand to say that on this reimbursement there is no GST. But right from 2013 March, even during service tax regime, it has been clearly laid out that reimbursements are very well part of consideration and it is taxable. When it will go away from the purview of GST or service tax was that only if we can prove that it is incurred as a pure agent. Now, an auditor is not a pure agent because the service of traveling, the service of food, the service of accommodation are not enjoyed by the bank, are actually in fact enjoyed by the auditor. So the auditor becomes the consumer of that service. So he cannot say, I become the consumer and I am your agent for doing this. No, you have consumed it. So we can never call those reimbursements as away from GST. They should all form part of our billing and we should raise invoices on the bank. Some of the banks have intelligently told that all this you incur, but that is the traveling expenses, the stay, the food, you incur. But do one thing, get the invoice in the name of the bank itself. Now in this case, there is a possibility of pure agency kicking in because what they are doing is the bank itself is directly going to pay them. So we are not going to pay and we are not going to get reimbursed from the bank. That scenario, yes, there is a possibility to circumvent this. But if that is not done, the invoice is being taken by us and getting reimbursed. 100% GST applicability is there as it is applicable on our audit fees. So we have to charge including that in our audit fee. And now we get to the reverse charge related provisions, which again from a bank branch perspective as well as at a regional or zonal level, we have to check and verify. And when I went through this from a bank audit perspective, I was surprised, in a way shocked to find out that most of the reverse charge provisions are applicable only for a bank. 90% of the reverse charge provisions are hitting the banks. So we have to be very careful when evaluating their reverse charge liability. Import of services. The first service where the banks can get caught innocuously. How? Software import. They might have downloaded one software and that software they would have paid in foreign currency. Fine. The moment you download a software, pay in foreign currency, you become a person who is importing that software service. You are liable to pay GST under reverse charge. One. Second, technical consultancy services. Any kind of foreign consultants or foreign agency reports that they have procured, foreign credit related documentation that they have procured by paying any fees to the foreign agency will all form part of import of services. And that import of services, they are liable to pay GST under reverse charge. Check whether this compliance has happened. And from a proprietary angle, if they have paid GST under reverse charge, check whether the ITC has been availed. And that ITC is restricted to 50%. So that whether they are eligible. If they are eligible, have they taken only 50%? Should also be verified. The first reverse charge which can attract a bank is this reverse charge of import of services. Then comes the topic of discussion. In the last 10 days, it has been done to death across all WhatsApp groups. Payment to directors. Whether section 192 TDS has been done, section 194J TDS has been done, payment to directors, will it become taxable under GST? The simple answer is as long as it is for the purpose of employment and there is an employment contract, it will go under schedule 3. Consequently, it will go away from GST because it is not a supply. If it is not going in schedule 3, that is, it is not becoming a employer-employee relationship related payment, then of course, yes, a services rendered by a director for which the bank is making any payment shall all become taxable under reverse charge. You need to be aware of that, and that whether it has been complied needs to be checked. This can include all the board members, their sitting fees, their conveyances, their reimbursements, because as reimbursements are taxable in case of an auditor, the same reimbursements will also form part of taxable value in case of director service. It has to be included, and on that the reverse charge needs to be paid. The next one is services from government. Any kind of licenses, any kind of approvals, for that the fees has been paid by the bank. Those cases, the bank will have to pay GST under reverse charge because it is a registered person. It is receiving services from, be it either central government, state government, union territory government, local authority. From any of them, they are liable to pay GST under reverse charge. Has it been complied? Needs to be checked. The next reverse charge that we may have to be going through is security services related reverse charge. This has come into being from 1st January 2019. So it has been applicable right across the financial year 1920. The provision that is applicable is security services where the security agency happens to be other than a body corporate. It could be an individual or a partnership. If it is an LLP, this provision doesn't apply. It is a normal charge. Other than a body corporate, if the security services is going to be received by the bank, reverse charge is certainly applicable. We need to check whether they have paid that reverse charge. Eligibility of credit again depends upon section 17, subsection 4, 50%. That rule whether it is applicable, we need to go through that. The next one, the new entrant into the reverse charge came into being from 1st October 2019 is this renting of motor vehicle, which is common, very prevalent in banks. renting of motor vehicle from 1st October 2019 if the person who is giving it on rent is going to be other than a body corporate. So it is again the same scenario, other than a body corporate. Then the one more condition has been put in place where the GST that is being charged by them is other than 12% or 18%. That is if they are charging 5%. So it could be a registered person also. But if they are charging me 5%, then I am only going to pay GST under reverse charge. So the banks or the financial institutions must check whether the supplier of security services or renting of motor vehicle services happens to be other than body corporate. And in case of security services, that is enough. Next minute, they are supposed to pay GST under reverse charge. But in case of renting of motor vehicle, they need to do one more checking, whether they are charging them anything other than 5%. If yes, no need to pay reverse charge. If no, then the bank should have only paid reverse charge on those renting of motor vehicle services. And renting of motor vehicle services, as I said earlier, has become applicable only from 1st October 2019. So the compliance for the second 6 months of the financial year needs to be checked. The next service, which is very common in a banking scenario, is legal services. Legal services in terms of retainers they might have for opinions and for taking up their cases. In all those cases, whether the legal services fee paid to a lawyer who is defined as an advocate under the Advocates Act 1961, whether reverse charge has been paid by the bank on those legal services related fees. Legal services, very carefully we must ensure that only the lawyer related fees are included there, because we have seen in the past that people have included company secretary fees also under legal services, which is not required in the first place. If they require and pay under reverse charge, it becomes a tax that need not have been paid. So then we go into another problem, whether they can avail ITC for it. Technically speaking, no, they cannot avail ITC, because it is not even a eligible ITC. It is not even a tax that was liable in the first place. So we have to check whether legal services, the compliances are proper. And then the further reverse charges, which are specific, which, as I said earlier, for banking and financial industry only, there are certain reverse charges. The first one is business facilitator services. There are two kinds of people which a bank can get associated, especially the banks in the rural area, not in the urban area. For them, there will be people called as business facilitators and business correspondents. Two kinds of people can be there. The business facilitator services received by a bank, the bank or the financial institution is only liable to pay GST under reverse charge. The business correspondent services, there is no reverse charge liability on the head of the bank. That is a separate reverse charge, which is on the business correspondent only. So we need not worry about it while doing bank audit. So when we are doing bank audit, the business facilitator service needs to be kept in mind. The second service, which is for the banks unique, is the recovery agent service. The recovery of the non-performing assets, where they have engaged somebody. So in those recovery agent services, it is the responsibility of the bank to pay the reverse charge on the recovery agent services fees. It is not a normal charge, it is a reverse charge. It is happening only in case of, that is, the business facilitator or the recovery agent services are specific only to this industry, the banking or the financial services industry. The other services also, which can come as part of reverse charge for the banks, would be the arbitral tribunal services. The bank might be in arbitration with respect to certain fees or any kind of invoices in the past, for which there is an arbitration that is coming through. That arbitral tribunal fee that is being paid by the bank, they are liable to pay GST under reverse charge. And then the most common for all the banks is the sponsorship fees. Most of the banks engage in the sponsorship of any events, sponsorship of any sporting events, any kind of charitable events. Check whether it partakes the nature of sponsorship. If it is in the nature of sponsorship, yes, the sponsorship fee would certainly attract reverse charge, and that reverse charge, whether it has been properly complied by the bank, needs to be checked. And then the other two services, which are again unique only to bank, are that one, a direct selling agent services, DSA, loan selling agents, card selling agents, those people. But in this case, reverse charge will get attracted only if the payment is made to a DSA who happens to be an individual. So it's a partnership, LLP, body corporate, anything, there is no reverse charge. It is a forward charge basis. But if the DSA, direct selling agent, happens to be a individual, then yes, reverse charge will kick in. The bank or the financial institution must have paid GST under reverse charge. The next one is on the priority sector lending certificate. Here it is unique. The priority sector lending certificate is treated as goods. The priority sector lending certificate is traded, I think, through the RBI, where the bank can procure the priority sector lending certificate traded by the other banks just to prove that they have so much of exposure to priority sector. That lending certificate, when they procure, one, it is to be treated as goods. Second, on the priority sector lending certificate, goods procurement, they are liable to pay GST under reverse charge. Many people have either not noted this or not even aware of this. This became applicable from 1st January 2019. So for the whole of the financial year 1920, any priority sector lending certificate procured by a bank, they are liable to pay GST under reverse charge, treating it as goods. That we need to check whether they have paid. The only issue that we have come across so far in this priority sector lending certificate is that whenever it is being procured, the procuring bank is not able to know from the system that is there currently as to who is the person who has sold it. For example, I am Indian Bank. I am procuring it through the priority sector lending certificate portal of the RBI. I know that I have procured it. It is there with me, but I do not know who has sold it. Let's say I am situated in say Tamil Nadu, but a bank which has office in Mumbai has only sold it to me. Then I need to pay IGST reverse charge. But this we are not able to identify because it is not being reflected. So the banks have taken different stands. Certain banks are only paying CGST and SGST. Certain banks are paying IGST. But what we need to ensure is, have they paid reverse charge on it? They cannot take a stand that they will not pay. They have to pay. But whether they are paying CGST, SGST or IGST doesn't matter, because in this case there is a problem that they cannot identify whether they have received it from a person who is not in the state or who is in the state. But they have to pay. We need to ensure that whether they are making the payment of reverse charge on this priority sector lending certificates. This will not be available under services. This is a reverse charge which is under the notification 4/2017 of IGST as amended subsequently. It is under the goods related reverse charge. So I think that pretty well sums up in terms of what are all the critical provisions that we need to be aware of in terms of doing the bank audit for the financial year 1920. Now I think I can take some questions. I'm requesting the organizer, Mr. Jose or Roy sir, to tell me how we can go about it. For the moment, I'll go through the questions that have come on the chat. Yeah, there has been a question where what is the status of,
please?
Yes sir?
Yes, you can proceed, sir. You can proceed.
Yeah. What is the status of advocate bill to bank for valuation/legal service? Who has to pay GST? Obviously, the bank will only have to pay GST under reverse charge. Any services by an advocate under Advocates Act 1961 done by them, legal services. What we need to be careful here is legal services done by an advocate. If it is coming under this, the bank has to pay reverse charge.
Sir, may I ask? I am Lucas, sir.
Yes.
May I
Yes,
ask?
sir. Please.
Sir, in the case of senior advocates,
Yeah.
what will be the position?
Sir, reverse charge on the bank is applicable.
No, I am not asking on the bank only, generally.
Ah,
If the service is received by the advocate from legal senior advocates.
what you are saying is an advocate is receiving from a senior advocate.
Senior advocates.
Correct, sir.
And if
In
it is
those
for
cases,
another client or if it is for himself only, what will be the reverse charge position?
okay. If it is received by an advocate, from a senior advocate. Correct, sir? That is what you are asking.
Yeah.
Okay. Then the senior advocate would be the one who has to register and pay GST or collect GST from the advocate.
Senior advocate has to collect.
Yes, sir.
If the service is used by the advocate for another client, his client,
Yeah.
his client has to collect the reverse charge for the senior advocate's fees also.
No, sir. There are two ways of billing. The senior advocate is billing the advocate, and then the advocate bills the client. This is model 1.
Yeah.
Model 2, senior advocate directly bills the client.
Yeah.
The advocate will also raise for his activity to the client. This is model 2. Model 1, where senior advocate does billing to advocate and advocate subsequently does billing to client, two GSTs will come. One will be forward charge by the senior advocate.
Yeah.
The second will be reverse charge by the company which receives invoice from the advocate.
Yeah.
Model 2, where senior advocate also raises invoices on the company and the advocate also raises invoice on the company. In both these cases, the company will only pay reverse charge. Company will only pay reverse charge.
Reverse charge on the bill of the senior also.
Yes, sir. Because they have received legal consultancy services.
Yeah. Thank you.
Yeah.
There is a question, sir. I think.
Yes, sir. I am looking at the next question. Penal interest in case of NBFC, whether GST applicable. There is no distinction between bank and NBFC, sir. The only thing that needs to be looked upon is the transaction. Whether the transaction is in the nature of lending and there is a repayment for that lending, then the penal interest will form part of the consideration called interest. And the interest being exempted, it will get exempt. But if it is not lending, if it is in the nature of installment, where a mobile company is selling the mobile phones on installment and say you pay every month 10,000 rupees to me for 10 months, and there they are charging a penal interest. It is not in the nature of lending or advancing. It is in the nature of collecting the money in installment. There the penal interest will become taxable. Okay. And then the next one is the in case of bank branch audit, GST compliance at HO level only. In case of reverse charge and director salary paid by a company, company can cover input tax credit. First part, sir, GST compliance at HO level, no, sir. They need to do it on a state level because the GSTN, how many GSTNs they have to do it. Different banks have different methodologies. Certain banks have given it to state level, that people do the filing at a state level. What we need to check is whether we have been vested with the responsibility of only the branch or a zone or regional level consolidation. So accordingly, our compliance checking will also get enlarged. The second part of the question, in case of reverse charge on director's salary paid by a company, company can avail input tax credit? Yes. But the word salary that you have used there is something which is giving rise to a question. If it is a salary and there is an employment contract, I am of the view, sir, that we need not even pay reverse charge on that because it becomes an employer-employee relationship transaction. So there is no GST on that. If there is no GST, cautiously we will go and pay the tax and take ITC is a stand that people are advocating, which I am not subscribing to because ITC can be taken only on eligible credits. When you wrongly pay tax, you cannot overcompensate by availing ITC on that. You can only go and claim refund on that. So we have to be careful there.
So, sir, regarding this, what about the advance authority ruling? Authority for advance ruling is telling, what will we do now? What will advance?
Sir, please note, as I have told multiple times, advance ruling is always adverse ruling, and that adverse ruling is applicable only for the poor person who has asked that question. So what we can do is we can learn from other person's mistake. So we should never approach them to whatever has been told there is applicable under section 103 only for that person. It is not applicable for us. If department is going to come with a notice, happily accept the notice. By the time they convert it into anything substantial, in many courts it would have got shut down. So legally there is no basis for it, sir. That is one. And the next question that has come to me is, what will be the tax rate for renting of motor vehicle under RCM? we are going to pay under reverse charge, we can pay 5%. There is no problem at all, because the person who is going to give the services, he pays 5%, that is not acceptable. But we can pay under 5%, we should pay under 5%, because from a proprietary angle, any amount you pay extra, you will not get ITC. Even if 5% is not eligible. So we should not be paying anything more than 5% is one. And the next question. RCM paid on directors, whether cross-charging is to be made. Another big area which has been opened up only by the Columbia Hospital case in Bangalore. Again by the Advanced Ruling Authority, where they said that employees working in one location servicing the other location, we have to raise invoice. I still don't subscribe to that view, sir. If we start doing like that, we will have a question whether employee is for a branch or employee is for a bank. I cannot say I am an employee of this branch. You are an employee of the bank, deputed in this branch. So if the same logic is say attributed to the directors also, they are directors of the company. They are not directors of a particular branch to distribute everywhere. So I don't subscribe to the view of distribution or cross-charging in those cases. The next question, insurance and repair of vehicles in case of bank, whether GST input can be availed by the bank. The word vehicle has been used, sir. So this again makes us or makes it necessary to go into the 1st February 2019 amendment, where it has been told if the vehicle is eligible, then the insurance and repairs are eligible. So for the vehicle to be eligible, the first question that we need to answer is whether the 13% seating capacity has been fulfilled. If the 13% seating capacity is fulfilled, that means the vehicle is more than 13% seating capacity, then only the insurance or repairs can become eligible. Else, it will not be eligible. The next question. In case of Rule 36 sub Rule 4 relaxation, which needs to be cumulatively satisfied by September 2020, there would be a situation that taxpayer will lose a good amount of ITC as he has to comply with section 16(4) also. How would be the impact? I assume that 16 subsection 4, your question is with respect to paying within 180 days. First I will answer with respect to the current provision, then I will try to foresee the future. The current provisions say that within 180 days I have to make the payment. So 36 subsection 4, the appearance of those invoices in my 2A are two discrete events. As long as it is appearing in my 2A, then I can take the input tax credit without any dispute, is what is the first part. The second part is the credit that is availed, whether I have paid the supplier within 180 days, I strongly feel that we will get an ordinance route or by way of a notification, whichever they find the fitting. The department might say this 180 days condition shall not apply for this period from 20th March till whenever the lockdown is lifted. So this period, they will say that will have to be excluded while calculating 180 days. When that comes, I think this problem will get solved. People will not be robbed of their working capital. Okay, if travel reinvestment to director is on actual basis, will RCM be applicable? The director happens to be not an employee, then in those cases, RCM will still be applicable, sir, for the reason that the director has been using that service. So he has consumed that reimbursement for rendering his services. So it is not that he has incurred for the company, he has consumed it for his activities only, which means it is absolutely includable, and we have to pay reverse charge including that also, along with the fees or whatever that is liable to the director.
Welcome Central Council member Babu Abraham Reddy to this meeting. Also, can you make a few words?
నిన్నే పిడిచాడు నూడిల్స్ అసలు ఆగులా ఇంకి ఆగులా At the
It's okay, it's okay. No problem.
But
Sir,
there is
you
one more question.
continue.
Yes, sir. There is one more question. Notification 35 extension. But the system is not used. Exactly, sir. That is the problem that I elucidated earlier also. Though section 168A, they have said that the extension time, that is from 20th March till 29th of July, whatever falls due shall all be postponed to 30th of June. The GSTN, the portal asset, is not tuned to that. So what it does is, it is rejecting. The officers are not able to stop that rejection. I feel that technical glitch will be resolved soon because the law should prevail over even whatever technical glitches that they have. So we don't have to be apprehensive in terms of applications getting rejected. Yeah. Okay. There is another question, sir. There is a new restriction on the value of zero rated supply as minimum of actual or 1.5 times the domestic supply. Can you brief on the adverse impact? Now, this is something which I would say they have done to reduce the amount of refund that is being claimed because ITC, they are not able to verify on one hand, hence they have done it. But I don't think this will sustain because there is a high possibility that I'll be doing more than my domestic supply 2 times, 3 times also. There could be a windfall order. So this certainly has an adverse impact in terms of refund applications, and very soon, if it is directly impacting your industry, I suggest please go for a writ petition because by the time it takes its natural time to come back, 2 years time should have elapsed. So if it is affecting you, please take a writ petition and challenge this is what is my suggestion. And renting of motor vehicle business, charging 18% on rental income. Whether can we take GST import on vehicles used for renting purpose? If I am in the business of renting of motor vehicles, yes, possible. But if I am the recipient of that motor vehicle renting, then the restrictions will still apply in terms of whether it is more than 13% seating capacity and used for the purpose of your business. If travel arrangements are done directly by the company, still RCM will be applicable. Absolutely not. Which is what I told you earlier in terms of audit fees of auditors also, where we don't get it reimbursed. It doesn't come and hit our accounts. It gets directly routed through the bank or the company to the person who is supplying the services to us, the travel company or the hotel company. Then we don't have a problem at all. That need not be included in our taxable value because a GST would have been charged on that invoice, which would have gone to the recipient, which is the person who is paying the consideration, the company. So in those cases, there is no RCM on that. There is no need to include it.
Any other queries? Sir, I think there won't be any other queries, I think. Narayanan sir.
Fine, sir.
Babu sir for few comments.
One more thing is coming.
There is one more query. How GST is applicable on sale of fixed assets on which no input credit is taken by the assessee? Straightforward, on the sale value, that is the transaction value, we need to pay GST at the rate prevailing for that item. If it is sold as scrap, if it is sold as second-hand machinery, whatever that machinery attracts the rate, that rate shall be applied on the basic value, that is the sale value, and GST needs to be collected.
Do you think is there any other particular area where the branch auditor one have to be a little bit more careful about with regard to GST?
At a branch level, I don't think so, sir. At a branch level, I think most of what we have discussed has been covered. At a say a consolidation or a sort of regional level, like the filings, the maintenance of registers. Because what happens is, all the branches, say for example, this might be a little away from the statutory audit perspective, but still worth to look at for auditors. Is first thing which many banks either they miss out is the number of branches that they have across the state must be included in the registration certificate as additional place of business. Whether actually that has happened, that needs to be seen. If they had opened new branches during the year, we should check whether the certificate contains the new branches addresses also as additional place of business. One, and then the registers that need to be maintained. For example, all our outward tax liabilities, all input tax credit related registers. If they are saying that it is being maintained in the core banking software itself, then at least an extract of it in terms of whether it gives the needed information needs to be checked. So that can be an additional compliance which we can do from a proprietary angle, whether the registers and records are being maintained. And especially like I told, the reverse charge scenarios, wherever the reverse charge liability is there, we need to check from a bank's angle whether it is being done at a local level or whether it is being done at a region level. Whichever level it is being done, when we get to audit that, check whether that compliance has happened, that register is being maintained for import of services, reverse charges. So these are the additional compliances which one may extend and look at.
I think there is no other queries. So that I think in that case, I think we will wind up early.
Okay.
So passing on to Jose for panel vote of thanks. Before that, I think let me once again thank Shankara sir, because it was we lost an opportunity to have a wonderful session, a workshop we were planning on in March, but unfortunately we could not do it. It was, I think, I feel it was a very good session, which is very useful in the angle of language also.
Yeah, one more question, one more query is there.
What is the rate of GST in case of sale of old car which is purchased before GST and the same is under the head fixed assets? Now, first part is we have to go by notification number 8/2018. As per that, if in all probability the motor vehicle, when it was procured, neither the sales tax credit nor the excise credit would have been eligible for the bank. So in those cases, what we need to simply do is, if we have not availed any ITC, what we need to check is the WDV, the return down value of the asset, as per income tax act, section 32. Section 32 will promulgate a block of assets concept. We can keep it aside. Think for a moment that this is the only asset in the block and calculate the WDV. Take the WDV and reduce it from the selling price. Only if the selling price minus WDV is going to be positive, we need to pay GST. If the selling price minus WDV is going to be negative, we don't have to pay GST at all. This is the first part. If the selling price minus WDV is going to be positive, then what we need to do is we need to pay as per notification 8/2018, of which the maximum rate is only 18%. It ranges different from the size of the vehicle and all. It is 12% also in some cases, 12 or 18%. There is no compensation set on that sale. There is no 28% also on that sale.
Why, sir?
Yes, I think we can
Can
fix
we-
it. I think once again, I am reminding all of you once again. I think you can have 2-hour unstructured CPA credit. Log into ICAI website and submit your claim in CPE link. And nothing more. I think those who are not contributed anything for COVID ICAI relief funds, please rethink about it. Send your contributions either to ICAI directly or to the branch. So this is all I want to tell you. Over to Jos.
Thank you, Chairman. I think our CP credit we can claim through cpicai.org.
Yes.
Chairman. Yeah, because there was a query. I think it is cpica.org. That is the website. We can claim the CP credit hours. So thank you very much, Shankara sir.
Once again, Jos, there is that same question again asked. What if no depreciation claimed at all?
No. Okay. What if no depreciation claimed at all? Section 32 depreciation is compulsory as per Income Tax Act. So I don't think there is any possibility of a person saying I will not claim depreciation. It has to be claimed. So we have to calculate as if it has been claimed.
Yes.
Okay, I think all queries are over. Thank you, Shankara sir, for that wonderful session. It is really practical issues what we are going to face in the bank audit, and of course, I think we have to make a checklist based on your, the presentation, and we have to check each item. As you said, the reverse charge is the only one where entire reverse charge is applicable to banks. So definitely we should be very careful on that also. So thank you very much for your wonderful presentation. Thank you very much on behalf of Ernakulam branch and as well as all the participants here in Zoom as well as YouTube. I thank you, extend a sincere gratitude to you. Thank you very much, sir.
Thank you, sir. Thank you.
And all the participants here in Zoom as well as YouTube also. We have a lot of participants in YouTube also. Thank you very much, all the participants, and I hope we will have a wonderful audit season, bank audit season. And this GST, this webinar will be very much useful to all of us in this coming bank audit. Thank you very much once again.